Hey everyone, John Henry here, SlingshotFutures.com. Today we're going to be taking a look at crude oil. Oh man alive, crude oil has been getting absolutely battered over the past couple days. Well, actually the past couple months now. And really, what's the game plan? This thing just today is down $3.70, and that doesn't include the fact that, from October it fell from the high 70s all the way down to where it is now at 56. What's the game plan with crude oil, right? What is the approach? What are some major things to be keeping an eye out to potentially find some opportunities? Well, first of all, obviously, the market's bearish, right? The market has moved below every moving average, basically. Everything is pointing to the downside. In terms of a technical perspective, it's very obviously bearish. Ichimoku clouds, whatever. Now, one of the things that I love looking for is any previous areas of potential structure. Now, market structure can come in a lot of different forms. It can come into an area that has several previous tests like we had through here. That is a beautiful zone of market structure, and the market responds to those areas very well, typically. But sometimes you're left with this just giant open door where there's just a bunch of open space and there's not really a whole lot to work with, kind of like what we're seeing here with crude. This move down has completely shattered any previous level of structure they potentially had. There are a few that may be left, a few, but there's not many. Major swing low right here, absolutely pummeled through that. Other swing low below that, and other swing low below. I mean, they're not paying attention to any of the swing lows anymore. So we can't really utilize a swing low bias. We need something stronger. We need a structural level of interest. Now, hopefully, with all the videos that we've done on market structure and the overall movement, it should be very obvious on what I'm going to be looking at next. And that's going to be this major level of support over here. Now, I don't think it's any surprise to really anybody when I point that one out once you kind of see it, but that area becomes a very strong level. Now, there's a few reasons for that. We can mark up each one of these highs. That wasn't even close. Let's try that again. There we go. And then we have one up there, and then you've got one kind of in the middle, right around there. So we have this cluster of support, and whenever we have a situation where there is a bunch of support levels all in the same zone, we kind of want to find the median, right? We don't know if it's going to be the high, the low, whatever one is going to hold, but we know that we're likely going to see a response somewhere around this. Now, this is a daily chart of crude oil, okay? So when we're talking daily chart, just because I say, oh yeah, well that level of support in the middle is at 54.94, right? That's where it is. Well, not really. The market doesn't operate that way in terms of exact levels like that when you're talking about a daily chart. We're talking about a daily here, and that means that we need to zoom out and kind of look at these more as zones. So because of that, this gives us an area of interest that right out of the gates is going to be a likely zone of at least a pause or a bounce on the daily time frame. You might get stuck there for a day and it goes torching down another $4 below that, but it could end up being the bottom. You never know. So what we need to find are other things that line up with this hypothesis, right? We need to find other things that are saying, okay, yeah, this area compared to others are going to give you a potential bouncing area. So what do we have? Well, we can utilize Fibonacci ratios, of course. Fibonacci ratio is very popular, and if we draw this up, we can see that this lines up almost perfectly with a 61.8% retracement area. That's at 55.36. Now again, this is a zone, and a zone in the daily chart can be as wide as $1 or two, but that's kind of what we're looking for, right? So now we have a 618 retracement, or in this case a pullback, towards the $55.36 mark. We also have a cluster of support and resistance, if we zoom in real close here, at 55.24 at the highest and 54.51 at the lowest, with a midpoint inside of there at 55.03. Of course, whole dollar at 55 could also be something to pay attention to. So we know that we have a structural level of interest, and we're building a case as to why we like or don't like a specific area. Now, one other thing that is very popular when we're talking about a big blow-off move like this is simply looking at it and saying, okay, you know what? This is going to be an area of interest because of a deviation to the downside or XYZ, right? It could be any number of reasons. And we're just trying to find one that has multiple levels of confluence. Ooh, I think I just turned off all of my global drawing objects. Let's turn those back on. There we go. So really what we want to try to find are areas of interest that show up all around the same place. And we have one, a 61.8% pullback, 55.36. We also support coming in around that $51 mark. But you also have a negative move, meaning that we had a move up, a pullback, a higher high, and an immediate reversal down. And whenever you have that type of sharp response off of a top or bottom or anything like that, this leg, the high and the low of that move, or in this case, if we look at the actual chart from here to here, becomes a measuring point. We can utilize this as an area of interest. Now, a lot of times markets love to respond to the 61.8%, but a lot of times as well, they like responding to the full 100% deviation. So those are the two things that we want to keep an eye on for that as well. So we'll draw from the top, and we'll drag this down to the bottom of that swing, and we'll give this a couple extra levels here. So we'll make this a negative 618. Then we also want to add a negative 100, and that is the full deviation down. Are you seeing a common picture starting to show up here? We have the negative 618, which is lining up right there at 55.85. We have the 618 of the pullback, the move from up to down, at 55.36. We also have previous structural support at 55.24, 55.03, and 54.21. 51 rather. So we're obviously showing some signs of interest at around the $55 mark. It could be a little bit higher, like 55.85, like we're seeing here. It could be a little bit lower, like 54.51. But this is giving us a general idea that in the short term, this sell-off, although very aggressive and probably relatively shocking to the system, might be grinding down for a couple days. Now, again, it might just bounce there for a day and then collapse another $7, right? That's the markets. That's how they work sometimes. But when you have multiple levels of confluence all stacking up in the same place and showing you, hey, this is an area of interest, because we know that multiple types of traders are going to be keeping an eye on this area. You have Fibonacci traders, you have structural traders, you have divergent traders coming off of the highs, which I haven't gotten to yet. Spoiler, sorry. And then you also have the deviation traders who are looking for the down move. Now, again, a couple other things. I kind of, let the cat out of the bag on that one. But if we go down to one of our favorites for slower moves, which would be the MACD. And we load up the MACD, and we take a look at this, and what do we have? Well, we have a multiple divergent high that's being formed across the highs. And that's been forming ever since the beginning of the year. So we have a multiple level of interest that's creating a zone that is showing that the market should dive down, but we are getting into a point that might be a little overdone. Now, one of the very common indicators that we talked about pretty frequently when we're talking about, markets being overdone or being overbought or oversold, as it were, is not the stochastic or any of those, but it's going to be the RSI and the CCI. Now, when we look at the RSI, generally speaking, the RSI, what you want to see is, well, let me just put it up on the chart here. What we want to see on the RSI is the market getting below 30, right? That's this lower band. And preferably the lower the better. I mean, an extreme pullback would be like sub 10. So if we put a marker on here at 10, we can see that it's not quite there yet. Now, the chances of the RSI getting down that deep, that is a huge corrective phase, and it doesn't happen very often at all. Sometimes. But generally speaking, if it's below 30, that would be considered oversold. So right out of the gates, we can have a MACD divergence coming off the highs, showing that the market should kind of peter out at the highs, and it did, pull all the way down. We have buying support at the structure of the previous swing highs back in, what year was that? It's 2017, early 2017, some in 2016. So we have structural support from 2016, early 17. We have a Fibonacci pullback coming into the 618 at around 55.85. We have a divergent move off of the highs, showing that this pullback is likely going to be reaching for a deviation move, which is where we're sitting right now at 55.85, a little bit lower. So a lot of things are stacking up in the same place, and if we look at our common oversold indications, the RSI is below 30. If we look at the CCI, if we drag this over here, drag the CCI on the chart, we can see that the CCI is also relatively low. It's not as far down as it could be, but I mean, then again, neither is the RSI. But generally speaking, if the market ever gets below that negative 200 line, that is considered an extreme move and likely going to bounce, right? We have that over here. You can see the response there. We have that right here. You can see the response there. So generally speaking, we're not technically done yet. It could go a little bit further, which makes sense because we're looking for price support all the way down to the 54s. But we are seeing a potential of this ending sooner than later. And this creates a long-term, I mean, this is a daily chart after all, a long-term level of support in around 56 to 54. If you wanted to narrow it down a little bit further, because it is a relatively wide range, 55.85 as a structural level of support, 55.36 as the next level, and then we have 55.24, and that's going to be the major levels that I am going to be keeping an eye on in terms of a potential bouncing point. And this bouncing point, again, it could last a day, could last a week, could be the bottom for the rest of the year. You never know. But these are the types of things that we're always hunting for when you have these gigantic breakaway moves, because as we always talk about and as we know, the markets are hunting for an objective. And right now, they're hunting pretty aggressively. They've got the buckshot out, and they're trying to find where that next level of support is. And to me, the way that the charts are looking, we have supported around the 55 figure in the average, around the $55 mark. And that's going to be where I'm looking for a long-term level of support. So that's going to do it for this one. Hopefully you learned something about longer-term analysis. Hopefully you find it interesting, maybe something you can add to your tool belt, or something to at least keep an eye out for, to just kind of get a general idea of the bigger picture when we're talking about crude oil. As always, if you have any questions about it, feel free to send me an email, jbrink@slingshotfutures.com. Throw a thumbs up on the video to show us that you like the content. Of course, along with that, make sure to subscribe to the channel and ring that bell on the right side so you're notified every time one of these videos comes out so you don't miss anything important. Aside from that, I hope you had a phenomenal trading day today, and we will see you all in the next one. Thanks.